I think it's time to start. I'm Anne-Jacques Minet from Bocconi University, and it's my great pleasure to welcome you for this session of the Competitive Strategy Interest Group entitled Beyond Does It Pay to Be Green? Exploring Firms' Environmental Strategies. And so I've been invited to put that session together by Giada Di Stefano, who is the associate conference organizer for the interest group. So thank you, Giada, for that. And so the idea behind this panel is to really think about, moving past this establishment of a relationship between environmental and financial performance. So before we actually go into the content of the session, I have a few housekeeping notes for you. So this question is recorded. The session will be organized around five main questions, each of them introduced by one of our panelists, and then there will be every time a short discussion among the panelists. So as you probably realize, 5 questions for 1 hour session is a lot, so we have a lot on our plate. Still feel free to ask questions, make comments in the Zoom chat box. We'll try to address them as much as possible during the discussions, but it's very likely, unfortunately, that we won't be able to get at all the questions. So if so, please feel free to leave them in the chat box of the session details on the conference platform, and then we'll be able to follow up with them later. So the question of whether it pays to be green, as you probably know, has attracted scholarly attention for decades, with this idea that it would be interesting and useful to establish the business case for sustainability. And indeed, there are many arguments that suggest that there should be a business case for environmental sustainability. Environmental practices can lead to more innovation, license to operate, or access to certain market and resources. Environmental concerns raise opportunities for new industries, new technologies. Taking care of environmental impacts is part of risk management. It can improve relationships with stakeholders, lower a number of costs, like cost of energy, the cost of capital, even cost of labor. But the results, in fact, have been rather mixed, although there's a bit more evidence in line with the business case, which may not be surprising given there's this motivation to actually demonstrate that it exists. But that research tends to face a number of empirical issues that we are well aware of. Accessing firm-level data is challenging. Secondary data like ratings are also problematic because they're based on company disclosure. They don't converge because they all use very different methodologies to aggregate the data. As scholars, we use very different types of assumptions in terms of the shape of the relationship, or what is a good measure of financial or environmental performance, what are the right models to apply, and so on and so forth. So that literature has not produced clear, definitive evidence that it pays to be green. That said, we can ask ourselves as strategy scholars, one, if we think that companies are our main stakeholder, would they expect us to establish the business case? Are they waiting for us to establish that business case before they actually start doing anything? And even more than that, is that question of whether firms make money out of being sustainable what we ultimately care about as strategy scholars? So you can imagine that these are rhetorical questions. I guess there may be more value in understanding why for some firms actually tend to go all in and try to be carbon neutral and care about their environmental impact to a very great extent, and some don't. And what are the consequences for the environment and or stakeholders? Ultimately also for profitability, but maybe not only for profitability. And so in my own work, this is the 1 minute of self-promotion. I try to, I say Andy is giving me a thumb up. He's the one who said you have to do it, so I do it. So I try to explain heterogeneity within organizations in terms of the implementation of practices. And so heterogeneity based on the topic that is that we look at based on the organizational entity that we look at, and also over time. In fact, there is a lot of heterogeneity in implementation of environmental strategies within firms. Related to environmental strategies, I also look at how firms define the materiality of their environmental impacts and of their disclosure. I also think about how firms factor environmental concerns or regulations in their growth strategies, and in particular international investment decisions. And more on the side of the consequences for stakeholders, I look at how stakeholders perceive firms' environmental strategies, a different number of stakeholders and different types of environmental strategies. So in this session, we have a lot on our plate, 5 questions and 5 very distinguished guests. And I think we're very lucky to have them together in this session. So around the table. So the first question that Glenn Dowell from Cornell University will focus on is will firms go green if it pays? Question number 2, on which Quilly Chang from the University of Texas at Dallas deals with whether the focus on financial performance can undermine environmental performance, so kind of reversing the question to some extent. Yoon-Hee Kim from Fordham University will discuss whether it pays to look green and not be, aka to greenwash. Jarlo from the University of Minnesota will discuss whether it costs to be brown. And finally, Andy King from Boston University will discuss whether being green really has to pay, or rather if being brown should be or be made costly. So now I'd like to leave the floor to Glenn to start with the first question. And Glenn, you have 5 minutes.
Thank you for involving me in this, and it's great to see all of you and get the chance to talk about this important series of questions that you guys are all going to address. I think your opening remarks set this up really well. So a couple of things that I want to talk about here. One, you mentioned the problem with, for example, a lot of the data we use, and so I'm not going to go out on a limb, but I think many of us are on this panel and others that I've worked with closely are guilty of putting a lot of stock in, for example, sustainability ratings or environmental ratings as we try to measure these performance issues, and we try to link this environmental or social performance with profit. And they're really noisy, right? And so if we see a firm that's got a good rating, we see good financial performance, it's really not clear what we can conclude from that. And so what I want to talk about here is some work that I published a couple of years ago that flips the question around, and I think helps us to get at a more, if I can say this without sounding too arrogant, a more important question in a sense, like how can we look at what firms are doing and what entices them to go green or not? There we go. Sorry. So, the sort of central point here is when we ask this question, does it pay to go green or pay to be green? We're assuming that firms are going to do more of the societally good stuff if it's more profitable. And that, I think it's probably true that they will, if things are less profitable, they'll do less of them, but it's not entirely clear that firms will do more of the desirable activities just because they're profitable. And in fact, that's what I want to talk about. And I know, Andy, I don't want to step on your toes at all, but I know that you recently published a piece with Auden Schindler and a really interesting piece about this issue. And it was Auden's actually partly inspired by his book, Getting Green Done, where he described some very high rate of return projects that he was trying to get done at the Aspen Ski Company. And it wasn't enough. And that's, I think, a pretty common problem. It's not enough for something to be profitable for firms to undertake it. You have to be looking at more than just that. Sorry, I'm having trouble advancing. There we go. So I want to talk about this a little bit. There's at least 3 reasons why firms won't necessarily implement what look like profitable green opportunities, right? So one is inertia. And this is where my early work in my early stage of my career, I was an organizational ecologist, and I'm still sort of recovering from that initial framing of the world. But inertia is a real piece of organizations. They tend, organizations are rewarded for reliability and accountability. And part of that reward, the cost of that is they tend not to do things very differently than they did before. And so just presenting them with a profitable opportunity isn't enough to shake off that inertia. Risk. Because if we see something that's got a positive expected rate of return, that doesn't mean that all firms see it the same way, or in fact, that it's unequivocally positive for some. There are variations in the expected rates of return, even on something that is on average profitable. And then related to the inertia part is disruption. So one of the things that ecologists did bring that we should give them credit for is looking at change and saying there's a process and a content effect to change. And the content effect is we think on average we'll be better off for having done it. And the process effect is what is the kind of disruption and pain we have to go through before we can get to that. And when we start to think about this third issue especially, we start to see why some firms may not undertake what look like, from an external perspective especially, look like profitable opportunities. So back again to Ann's introduction a little bit, and this idea of data. So I worked with a colleague he's now at Penn State, Suresh Mathangan, and by the way, he's got another great paper using the same data set that's really interesting from a behavioral perspective. And we really, when he brought this data to me, I was just so excited because one of the things that we could do with it is we can actually look at 80,000 energy savings initiatives that were proposed to firms, and whether they implemented them or not. And we have the cost, the estimated cost, the estimated energy savings, and the estimated financial savings from them. And this is much different than this sort of aggregate coarse data on firms' ratings or and their ROI or something, right? We're looking at the individual initiative level. And so we found that, thankfully, again, I put there as a sanity check, we did find, yes, more profitable initiatives were more likely to be implemented, but there was a lot of other things, and most importantly, it was how difficult it was to implement that really made the difference. So if you look at it, I know you gave me the time's up, so I will rush through this, but if you look at this, all initiatives, we had about 50% got it implemented. If it was payback of under a year, that went all the way up to 52%. If it was payback under a year and easy to do, it went up to 57%. But if it was payback under a year and more difficult to do, it went down to 34%. So there's a lot more to this than just, is it profitable? It's how difficult is it to do and how many others are doing it. And I'm sorry, I went to 5 minutes and 40 seconds. Andy.
Glenn, if you studied another kind of thing in an organization, another function, inventory control,
yep,
would you find the same thing?
I think you absolutely could, right? And I think that's actually part of the point is we think, for example, some of these underlying assumptions, if something's more profitable, firms will do it, and that's just not true in any realm, let alone this one, right? And so inventory control, if firms were convinced that it was core to their operations, you might find a higher uptick on the probability of being implemented. But any initiative that is sort of peripheral to their strategic planning or their core activities and has disruption, I think you'd find a very similar result. And I think that's part of the point here, is that we need to look at this as a form of organizational change and use some of the models from that, not just look at it as like something everybody should do more of. Does that make sense?
Is that a question to me?
Yeah, well, I mean, most people aren't on video, so I can see your face looking sort of, the pensive king expression.
Yeah, or it just suggests that we're not completely accounting for all of the real costs, right? That there are real costs to this disruption. Yeah. And so when we do these kind of when the payback will be, there There are administrative kind of things that are getting in the way, and those are just across everything. And so everything we look at, we'll say, wow, they should do more of everything. And we just happen to be looking at this particular problem.
No, I think that's fair. And again, I think that's actually a piece of what we were trying to bring here, is that like people look at this and say, well, if there's profit to be made from being greener, then why aren't firms doing it? It's a market failure. And the answer is, well, because there's more to the story. If you think about this as the disruption and the kind of process effects, again, as in the ecological language, that has to be accounted for. Yeah.
I have could I quick clarification question? So you had all initiatives and then quick and something, quick and something, quick and something. Is this all initiatives include slow and something, or did you have those slow? Across the board.
Initiatives is across the 80,000
Interesting.
that we saw. So it's about a 50-50 chance. And I think it was a follow-up about 18 months after they were proposed to see if they'd been implemented. So it wasn't like in the next couple months did you do it. They gave them enough time to.
Okay. Thank you.
If I may, Glenn, I also have a question, because when I was looking at the paper that you mentioned, I was wondering, okay, so why? I mean, it seems like these firms, they voluntarily get involved in this program to just find ways to save money. So why is it that they don't go for the big wins? So could it be, is it because it's just window dressing and they want to communicate that they do that? But these are SMEs, so I'm not sure. So it's just that they would want the cheap and easy solutions and they don't find them.
Yeah, I think that's the interesting thing. And the other part, to try to keep it down to, let's say 5-ish minutes and not quite 5 exactly. Had to leave a couple things out, but one of the things, I think again, the problem, if we look at, say, MSCI ratings and accounting results, right? And you say, well, firms should be doing more. And you say, well, how do we know what firms are aware of? What opportunities they actually know they could try? And if you talk to managers, there's some confusion, right? What are these environmental, or what are the sustainability initiatives all about? What can we do? And one of the things that this allowed us to do was control for that. The managers were presented with a menu of suggestions from these industrial assessment centers, which are DOE-funded centers at like 26 universities across the country. So there was no question about their awareness, which is hard to control for in another setting. And then the answer is, the question you're asking is, well, then why aren't they doing it? If they went looking for this audit and they were given these, why didn't they do them? Well, and I think this is what we're getting at, is some of them are disruptive to the point where, yeah, I can see that this will have a return, but I'm not sure I believe the return is there, and it's going to be disruptive to get to it, which is back to Andy's point about when we say costs, we're not really taking all costs into account. We're taking the implementation financial costs, but not the disruption to routines and the kind of uncertainty that this brings. So one of the things we found, and I whipped past it, but firms were much more likely to implement something if other firms locally had done it as well, controlling for the cost of implementation, controlling the expected return, et cetera. Right. So that's, that shouldn't surprise anybody in terms of diffusion, but it's interesting to be able to control for the expected profit and still find it.
Yes, so it seems like the social pressure is as powerful, if not more powerful, than the economic one.
Yeah, although it's interesting because it's more social proof of concept, we think, because these are energy savings initiatives like insulating a pipe or swapping out a boiler or doing some sort of custom fitting of energy efficient equipment. So it's not something very visible, right? So, economists look at, for example, conspicuous conservation and visibility. And then that's social pressures, right? If you're in certain areas of the country and you can show you're more ecologically efficient, that gives you some credibility. But when you're doing things that are largely invisible to everybody outside of the walls of the factory or the small facility, then it's more of I think it's legitimacy and proof of concept.
Thank you very much, Glenn. So I think we have to move to question number 2. and ask whether the focus on financial performance tends to potentially undermine environmental performance. And so I will ask Quilly to go ahead and share her idea.
Yes, good morning, everybody. So I'm actually happy to be here. And then now I'm actually nervous. I just made my slides in like 5 minutes. So I still want to share with you. Just take a quick look, okay? So this is my notes, okay? It's not really slides, but I figured it's probably better you look at this instead of like my exaggerated face, okay? So let's do this. So I'm responsible for the question of does the focus on financial performance undermine the environmental performance? Actually, been thinking about this question, and I think I would want to take it more about approach it from a intertemporal perspective, like a time. Okay, so the answer to this question is really like it depends on what type of financial performance that we're talking about. Okay, there are so the overall bigger picture wise is that it still goes back to the debate related to the shareholder privacy versus the stakeholder theory, whether we increase our environmental performance would actually create value to shareholders in the long run. So that Yoon-hee will comment on that in the next after me, right? So I will leave that point. So my observation is that at any point in time, right, there are still a lot of conflicting interests, so that managers and firms have to account for, right? So particularly if they do have to account for or face a lot of pressure in the short term, right, coming from different parties, then they will actually tend to engage in some sort of short-term oriented practices that may undermine the environmental and financial or social performance. Okay, so so that is basically fundamental intertemporal tension problem, right? So you kind of need to choose between like invest more in the long run versus to cut corners in the long run and then to boost up the short-term performance. And then in particular, right now, like recently, my research focus is particularly focused on the pressure from the capital market. So there are different kinds of stakeholders from the capital market that actually plays a relatively greater weight than others in terms of how they are expecting the firms to perform. And then once that pressure actually becomes exaggerated or becomes very salient, right, then the managers or the firms tend to like kind of have to adjust their investment horizon in the sense that they want to shift more to focus on their short-term performance. That might lead to the the lower performing in terms of the environmental performance, and then together with the other social related performance as well. So for example, right? For example, like financial analysts. So there are like a lot of research lately related to financial analysts, even like institutional owners. So and then recently there are also like activist hedge funds and the short sellers in the market. So all of those different stakeholders in the capital market, they actually present certain pressure to the firms and to make them feel like they have to perform or boost up their short-term performance. Okay, so so when firms, oftentimes, okay, there's actually a trade-off. Okay, when you focus too much on the short-term performance, you do actually pay in the sense that the long-term performance does not really benefit. So that's one of my recent papers. We actually find that there is an intertemporal trade-off between the short-term returns versus the long-term performance. So to what extent, okay, so look at my slides. My goodness, I feel terrible. So to what extent, right, firms are actually subject to this short-term performance pressure, right? It also depends on the relationship with all of the stakeholders, right? So for instance, there are some other group of the stakeholders which actually helps firm to mitigate for the short-term pressure, right? So let's say like a long-term institutional investors. employees, right, labor unions, and communities, right? There are a lot of research related to community, social capitals, and then environmentalness. And then one of the also very important factors is top management teams, their own temporal orientation, to what extent, their strategic vision actually affects that the degree that they can buffer the pressure from the capital market, so that they can still make a balanced decision making between the short term versus the long term. Okay, so in the end, right, it still comes to the point of the stakeholder salience, to what extent, right, that particular stakeholder group achieved the high salience in the firm, right, so that managers have to adjust their investment allocations between the short term and long term. If they focus too much in the short term, then which may actually come back to undermine their social and environmental performance. Okay, so well, in the long run, I do actually agree that it is very likely, right? And a lot of research already find that it's very likely that financial performance and environmental performance can be perfectly aligned, right? But then when we put the firm in an intertemporal horizon, right, oftentimes there are conflict that may arise. Okay, that's it. Thank you.
Thank you, Prilly. Given you mentioned her in your slides, I feel like I should ask Yoonhee if she wants to build on what you said and comment on that question.
Yes.
So what I prepared is looking green page or not in terms of environmental rating. So I don't have perfect answer for this particular question.
I have a question about short-term versus long-term performance. Is that different from just managers having different discount rates?
It could be, but not simply because of that. It could be part of that. So that's also kind of goes back to the point about some managers actually they do have actually relatively longer term horizon in terms of the temporal orientation, while some they actually have like they emphasize more in terms of the short term. So yeah, so partly yes, it could be the way that they discount, discount that, and then but then not only because of that. Let me put it this way. I think again, oftentimes they do have to address a lot of pressures coming from different parties, right? And then capital market is actually my feeling is that actually capital market is very cruel, in the sense that if you're not really performing, right? So it affects their career and then their job market mobility, right? And then again, of course, like lately there are also research talking about the whole capital market shift from the agency logic to stakeholder logic. But then I feel like that shift, we are still probably in the process of that. We have not really completely moved to the stakeholder logic yet. So.
I have a question too, which is, so Tilly, you mentioned various different kind of stakeholders, and they all matter. Do we have more kind of research on how do they work together?
That's a very good question, right? I think okay, so whoever can help me. So if I remember wrongly, right? So Olga may help me on that. So I think my impression is that yes, like right now we can see from faces different like a pressure from different parties. But I think I do not really see that there are like a very clear work that looking at whether the particular two types of stakeholders they are collaborate or really competing in that sense directly. So yeah, that would be a very good future research direction. So.
If I may just come back on to your previous comment, because you were saying, yes, there's this discussion that, you know, we should switch logic from shareholder orientation to stakeholder orientation, and the financial market is not there yet. I mean, I guess we see a lot of discourse around the, you know, social responsible investment, climate finance, and so on. So I think there is some kind of transition towards more environmental friendly finance. Do you think this is too slow?
Yes, if you ask me, I think yeah, we would probably benefit more if we can speed up the process a little bit, right? But again, so as I mentioned, my feeling is that the capital market is still very cruel. So despite the fact that we all know that, you know, we should switch towards that direction, right? In the end of the day, you know, managers still do have to face all sorts of, let's say, earnings forecast, you know, all sorts of like the target of the short sellers, you know, activists, hedge funds, tax, all of those things. In a way, is that the best weapon they could use to defend this is actually the financial performance. So, you know, it's kind of a, you know, this shift requires like all of us, not only the scholars, right, but also practitioners to fully absorb the point is that firms do or could achieve the win-win situation by performing well in both like environmental and the financial domains in the long run, right? But then again, oftentimes we do face a lot of short-term pressure, right? So that it's kind of still difficult, yes.
Okay, thank you very much. So we need to move on. So Unity, so I will give the mic to you now and to discuss whether it pays to look green and not necessarily be.
I think you're muted, Eun-hee.
So you can see my screen. So I'm Eun-hee Kim, Fordham University. Thank you for the opportunity to share my work. So I'm asked to talk about does it pay to look green, which is similar to does it pay to be green, but with greenwashing flavor to it, which makes everything so difficult. So I'm going to start by talking about my work with Akira Fabrizio titled Reluctant Disclosure and Transparency, Evidence from Environmental Disclosure. Active information intermediaries, such as the Carbon Disclosure Project, collect information from firms, evaluate, and disseminate. So interesting thing about this is that the evaluation criteria is available to firms. So the CDP puts out detailed scoring methodology publicly. So firms know when they are going to get points, when they are not going to get points, when they are going to get punished. So our question is, does this affect how firms report environmental information, in particular, negative news? And does how firms report in turn affect CDP evaluations? So we studied this question by looking into the possibility of linguistic obfuscation and its impact on CDP ratings, performance scores. So linguistic obfuscation refers to using complex languages and language structures to obfuscate the meaning of what's conveyed. So to get at this concept of linguistic obfuscation, we use a free text-based answer to the question. Subsequent to the yes/no question, is climate change integrated into your business strategy? The company is asked in the survey to answer one of the following. If yes, please describe the process of how climate change is integrated. If no, why climate change is not integrated? Explain. So we make use of this question to get at linguistic obfuscation. We use fog index to calculate the extent of linguistic obfuscation. Fog index is a well-known metric to measure readability. Basically, it looks at how many words per sentence and how many complex words per word. Complex words here defined as 3 or more syllables. So we use this along with CDP scores, 2 types of scores available. One, disclosure completeness, and the other, performance ratings. So we look at the interaction of these and to get the possibility of how firms report negative news and whether environmental ratings, CDP ratings, performance ratings affected by this. So what we find is that, one, firms that reveal negative environmental information use obfuscating language in their disclosure. And 2, the extent to which firms reveal negative environmental information, revealing negative environmental information use obfuscating language in their disclosure increases as they make more complete disclosure. So what's shown in this graph is the difference in fog index for firms that report negative news, less firms that report positive news. So CDP is very specific about what is positive news, what is negative news. Positive news includes having proper governance systems, climate change governance systems, like having board committees, board structure, incentive schemes, measurement systems, etc. And taking specific actions to reduce the impact of climate change. And not having those is negative news. So we define negative news as not having those governance system or not taking actions. So shown here is the difference in fog indexes for firms with no governance and no actions, less firms with all governance attributes and a mean number of actions taken. As you can see here, this measure increases as the extent of disclosure goes up. So as the extent of disclosure goes up, firms are more likely to reveal negative as well as positive news. And we see that firms that reveal negative news obfuscate more in their disclosures. And what's interesting about this is we further look at the impact of this on ratings. And we find that firms that obfuscate, they get smaller negative impact on their ratings, meaning that, okay, they get bad ratings than firms that report positive news, but the extent of that decrease in ratings is lesser for those firms issuing disclosures with higher levels of linguistic obfuscation. So in this sense, firms that in a sense greenwash, they get benefit in the sense that their ratings is higher than otherwise. So studying greenwash, possibility of greenwash is difficult because we rely on information revealed by companies, and we don't know whether that's truthful or not. So in this paper with Tom Lyon, we looked at the unique setting where we could differentiate reported reductions by firms and actual reductions. So we look at electric utility companies that are required to report their fuel consumption. So coal, oil, gas, what kind of coal, what kind of oil, and how much amount. So because of, during this time we studied, because there was no end-of-pipe technology that treat emissions, climate change causing emissions, we could calculate, based on fuel consumption, what the true climate change emissions are. So what went in, came out. So we compare.
You're out of time, so maybe focus on the conclusions of the papers.
Yes, so the idea here is that firms reported more reductions when actually emissions were growing. And if you look into more detail, then not only firms tend to greenwash, but they also tend to brownwash. And firms do so, like brownwash, when their financial performance is not good. So when they are under investor pressure, they are more likely to brownwash. Thank you very much.
Thank you, Amy. And I think that last finding is consistent with what we heard from Kuli before, that financial markets on average may not be very supportive of environmental initiative. And I think some of Tom's work, kind of previous work, is also along those lines. I wanted to ask you a question on the obfuscation paper, because this is about the CDP. So these are supposed to be expert raters. And so it seems like even for them, this is a strategy that works. So would you expect that, such strategies, I guess firms would implement the same kind of strategies for their communication more widely? And I know Donald Crayley and colleagues have worked along those lines as well, about, the way from manage to hide bad performance. And I would like to get your sense on whether this is a bigger phenomenon, because these are the experts, so they should be able to identify those practices, and apparently they don't.
Right, so we were actually surprised to see this impact on ratings. Kira and I was working on this, and we thought that, okay, it's not going to have any impact on ratings because they are experts. They should not be swayed by all these little obfuscation techniques. And we were surprised to find this. So our interpretation is that it's difficult to make negative evaluation when the statement is not certain. So that uncertainty creates kind of like anxiety on the part of those who come up with the scores. And when things are not clear, that they are hesitant to downgrade your performance rating. That's how we interpret it. I mean, more broadly, like so information intermediaries like the CDP, they come up with performance ratings, and the broader external stakeholders use that summary measure in their evaluation, or how they use that rating, whether that involves some kind of attack against companies, or even further, like even more general securities analysts. So what we find here is really, again, towards these expert raters. More broadly, how firms use obfuscation, we don't have specific evidence for that, but we know generally that firms like to highlight positive information and hide negative news. That the papers along that line's been, a lot of those has been published. So we know that that's happening.
Thank you. So I'm sorry to be rushing a little bit, but I think in the sake of time, we should probably have the two last presentations and then have a joint discussion on the two of them, so that we make sure we have time for the two last questions, which are important and related. So I think it's fine to group them, so to have them in a row. So we'll have Jal, who will discuss, does it cost to be brown? And then Andy, who will discuss, should it pay to be green, or should it rather cost to be brown, kind of bringing the two together. So Jal, please go ahead.
Okay, can you see my slides? Perfect, thank you. Well, thanks. It's really nice seeing everyone virtually, and special thanks to Anne and Giada and Competitive Strategy IG for putting this wonderful session together. I'm Zhao Lo from Minnesota, and my assigned question is, does it cost to be brown? And my answer to that is a simple yes. Yes, it's costly to be brown, and the cost could be in the form of penalty from the government, right? Fines, institutional pressures, activists to deal with, as you know, as the fabulous research done by many of our panelists, as well as many of you who's in the audience. But if I'm allowed to revise the question, like Glenn, right, I like to kind of twist it a little bit, to the question of does it cost enough to be wrong, then the answer I think is a lot less clear. So here's what I mean by that. If we plot the level of pollution as well as the cost, the red line would be the penalty, which is mentioned above. So the cost of being, which are the costs of being wrong. And then there's also, very importantly, to consider the cost of being green, right? The abatement cost, which could be very high if you want to reduce to zero emission, and very low to zero if you do nothing. So what we see is that firms don't always pollute at the highest level, right? They don't pollute at P1. Instead, they're polluting at P2, which means that they're already taking into account the penalty, the cost of being wrong. So, which is why the answer to Anne's question is a firm yes. But does it cost to be enough to be wrong, right? Or are we imposing enough costs on the firms so that they are environmentally conscious? That's much less clear, and there's at least 3 dimensions or 3 points that I want to make about that, which makes the answer less clear. Number one is, suppose P3, right, is the socially desirable level of pollution, or, for example, you can think of it as the level of CO2 emissions that we need firms to be at, so that we're effectively dealing with climate change issues, right? And that's obviously smaller than P2, and the question becomes, how do we move firms from P2 to P3? You could shift sharply, right, the cost of penalty. Alternatively, you could, reward firms more, right, by giving them kind of moving the cost of being green inward, right? So, but it's unclear, and there's no reason, I think, to think that we're, the current cost curve on both is giving us that, right? So that's point number one. Point number two is, it's even worse when firms are endogenously changing the cost curve of penalty, right? For example, they may increase pollution by paying for it, which is shifting the cost curve to the pink line. And that is what we show in my 2018 paper with Haramso, as well as Sinkel and Minnesota. What we show is that the firms that gives more in terms of in the form of corporate philanthropy, right? Essentially incurring a cost, a kind of a fixed cost here, but also kind of flatten the curve of the penalty. Those firms also pollute more in oil spill in the subsequent year, right? So when firms are endogenously shifting the cost of penalty, they actually resulted in a higher pollution level of P4. Lastly, notice that I've been, playing with linear curves, right? But the cost curves may not be linear. It could be like this and resulting in a P5. It could also be like this, where it doesn't intersect with the green curve, and therefore firms will be happily polluting at P1. So we really don't, have much idea about how those cost curves may look like. And thus, it's important to know that to answer this question. So overall, does it cost to be wrong? Yes. Are we imposing enough costs for firms to be environmentally conscious? The answer really depends, and probably not. We'll have to take into account the cost of being green. We'll have to take into account firms endogenously moving the cost of penalty, and also have to know a lot more about the shape of the penalty curve. So that's it. Thank you.
Thank you, Zhao. And I think we can move directly to Andy's comments, who I think has a lot to do with that penalty curve.
Yeah, and I will try to keep it very brief if I can, first of all, figure out what I'm doing here. Am I sharing my screen? Share screen. Share. Okay. Yeah, I mean, what I just took away from the last presentation is it depends. There's an optimal cost curve, and there's an optimal cost for environmental pollution or social injustice or something, and we may or may not be that at that point, and there are lots of ways to think about it. So all of the things that we've talked about could be, it depends. It could depend on the industry, the situation, the regulation levels, and so forth. I think it's important for us to think about why have we been asking this question about it, whether it pays to be green for so long. And the answer, I think, is because we really would love it if it were true. And because this goes back to Glenn's point, is if we could just, if it was possible that firms were systematically underinvesting in environment and social benefit, oh, wouldn't that be wonderful that we could just go in and sort of train them how to improve? We wouldn't have to regulate. There wouldn't be trade-offs. We could save the planet. It would be wonderful. We could have our cake and eat it too. And then a few riffing on Eddie Izzard at the bottom, if you guys know Eddie Izzard. So, and I have to say that I feel somewhat guilty about that because I was a little bit at the very beginning of this whole process, where in the early 90s, we were finding some companies that seemed to be doing good and making money at the same time, or I was discovering environmental pollution and then the reductions of it leading to cost reductions. And what happened, I think, is we extrapolated from a few cases to this is going to save the world. And, you know, so you can see from the evidence that we had in the early 90s, and well, and then we'd take those ideas and we'd come up with new ideas. Oh, it's green and competitive. Oh, we're going to do these 4 times innovation. If you remember Amory Lovins, we're going to have voluntary sustainable business. And then we do some sort of systematic analysis like you saw Eun-hee doing, where, you know, she's looking at the CDP data and it would be like, well, maybe not so much. It's going to be a little more difficult than we thought, and so on. And then, you know, the ideas would be reborn and they'd come back again and we have this new idea of how it was going to pay to be green. And we've gone through these cycles over time. And over time, I think where I've come up with is, you know, we have these ideas that it's going to pay to be green, but our environmental problems just keep going up. And we have year after year, we have a few of these come up. And I have come up to this is my new way of thinking about the world. You know, those annoying economists were right. We need systematic interventions. We need regulation. And he's laughing. I'm not calling you an annoying economist. You are a non-annoying economist. So I think the thing is, we have to make it pay to be green. You know, I mean, what Xiaolo just talked about is we have to figure out what are the external costs. We have to impose the social or regulatory penalties. We have to make it so that firms will change. I think Glenn is bringing up we may have to provide some support in getting them to reduce the frictions, but we can't ask firms to just internalize their true costs. We got to tax them. We got to stop pretending that management or insight will fix our problems. We need to regulate. For scholars, I don't think that means that we stop doing research in this area. I think every one of these papers presented or research presented is exploring an important management issue. You know, what are the internal frictions? What are the effects of endogenous strategy? You know, how do firms disclose? All those things are very important, but we have to be careful not to oversell what we find so that people think that this is going to be the way we're going to save the world. That's it.
Thank you very much, Andy, as well. So I think your last point of discussion is maybe the one we want to take home with us. And, you know, what is our role as strategy scholars now, beyond saying, oh, you know, we don't want to just say, oh, companies are not the solution, so, you know, let's regulate and and that's it. So I think just, you know, to try and summarize what I've been said in just a couple of sentences before we take maybe that question. I think, you know, we discussed that, you know, being green does not systematically pay. It depends. Being brown does not systematically cost. It depends. Looking green may actually be enough to convince stakeholders, shareholders, at least in the short term. Financial markets probably will not be sufficient to push companies to be green. So some level of regulation certainly is necessary. But then, yes, I think, again, it would be nice if each of you could, you know, give us their view on where you think strategy scholars have a role to play in, you know, trying to push that sustainability environmental agenda in a way that makes sense, that is useful in the future. So maybe we can, you know, keep the same order as the presentation. Sure. With Glenn, if that's okay.
I can jump in. Sure. So I think if we go back to, I think looking at, especially combining Andy's and his pieces and thinking about strategy, right? Strategy, a lot of it is about where does firm heterogeneity come from in the first place, and what are the implications of heterogeneity, right? Firms are founded at different times, they have different top management teams, different objectives, and I have long been in the same spot as Andy in terms of we need regulations. We can't expect that out of some mass goodwill, firms will take all externalities into account and do everything right. That's just not how the world is trending, as he pointed out with his delightful cartoons. That was really fun, by the way, Andy. So one of the questions strategists can get at is what seems to drive heterogeneous responses to these kind of institutional pressures, right? Why do firms respond differently even under regulatory environments? So we've got questions around the regulations that have been so predominant in the last couple decades in environmental issues have been information-based regulations, and firms respond very differently to mandatory information, mandatory disclosure, and what drives that, and how well do these work, are really great questions for strategists to ask. What are the capabilities and resources that allow some firms to respond differently, and what are the facets of the top management team, et cetera? Governance issues. There's a plethora of questions that get to this without getting into looking for some sort of the magic beans that'll grow us in a sustainable way.
Thanks. So maybe we can move to Quilly, then Hyunhee, and follow this.
I think in addition to Glenn's comment about the regulation, and we're talking, talking about some of the country in terms of the regulation costs, right? I think that is more from the external or the government perspective, right? So I think if we as scholars at the same time, right, could also like demonstrate or show to those managers of the firms, right, there are inherent trade-offs of those, focusing on too much in terms of short performance. You're actually going to suffer in the long run as well in terms of financial performance. So I think if we could do more research, really like demonstrating that, cutting corners to boost up short performance may not necessarily lead to your superior performance in the long run. That may also kind of help to, kind of shape from the firm's internal perspective, right? The managerial, logics, which Andy may not agree that it does pay off for you to be environmental sustainable, firm.
So, Anne, should I go? So, so we often hear a lot about these days, broad brush, win-win propositions, corporate environmental sustainability will pay off, things like that. But if we look at industry-specific evidence, that often shows counter evidence. So I think large-scale across industry studies are valuable, but also industry-specific evidence analysis that looks at the details associated with each industry, I think that might also be valuable in studying this link between whether green pays or not, whether looking green pays or not. So thank you very much.
So for me, I think, I learned a lot. So thank you for the session. Two things. One is that this is, I think, an area where a lot of new phenomena is coming about, right? Or different contexts. For example, Olga mentioned Caroline's paper, Green Bond, and Mao Liang in the audience has a fantastic paper on green innovation in China, right? So I think, as strategy scholar, we can do a lot to just understand those new phenomena. They may or may not be different from what we know, but I think that itself is really interesting. Second, while I agree with the role of regulation is going to be the key, we also can do a lot to understand stakeholder heterogeneity, right? And why, what is behind their motivation? How do they work together? Those, I think, would be useful to understand too.
Yes, Tuomas.
I just would say quickly, this group seems to be sober and pessimistic. Of what you see happening a lot among executives is enthusiasm and bold promises. And I think what we need to be as scholars is truth tellers to some of this propaganda, I believe, that's being put forward.
Okay, thank you very much. I think this has been an extremely interesting session. Indeed, not as optimistic as we would like it to be, but hopefully, you know, in 5 or 10 years, we can have a similar session in which you say, yes, we made it, or we flip. Let's see. In any case, I really want to thank our panelists for their contribution, their presentations. They all have fantastic work, so I really encourage you to read their work to know more about those ideas. And I would like to thank the participants as well, and Gerard and Stefano again for allowing me to put this session together. I wish you all a great SMS, and I hope to see you in person soon.